Welcome to the Growth Room. Today we're exploring one of the most influential investing books ever written, The Intelligent Investor by Benjamin Graham. In this audiobook summary, you'll discover the timeless principles that help shape some of the world's greatest investors and learn how to build wealth intelligently while avoiding costly mistakes. To truly appreciate the wisdom we are about to unpack, we first need to understand the man behind the ideas. Benjamin Graham wasn't just an academic sitting in an ivory tower. He was a masterful practitioner who survived and thrived through some of the most brutal economic environments in human history, including the catastrophic Wall Street crash of 1929 and the subsequent Great Depression. Having witnessed firsthand how quickly fortunes could vanish when built on a foundation of pure hype, Graham dedicated his life to developing a systematic, rational approach to navigating the financial markets. He became known as the father of value investing, a philosophy centered on buying assets for less than they are genuinely worth. His impact was so profound that a young student from Nebraska named Warren Buffett sought him out as a mentor. Buffett didn't just study under Graham. He internalized his teachings so completely that he would go on to call this exact book the greatest book on investing ever written. Buffett frequently attributes his staggering multi-billion-dollar success not to a secret formula or complex mathematical algorithms, but to the core emotional and intellectual framework laid out right here in these chapters. The beauty of Graham's philosophy is that it doesn't require you to have a high-tech trading setup, an advanced degree in finance, or an inside connection to Wall Street. It requires character, patience, and a refusal to let the crowd dictate your financial decisions. Let's establish the foundational pillar of the entire book, the crucial, non-negotiable difference between investing and speculation. In the modern world, especially with the rise of slick smartphone apps and viral internet trends, these two concepts are constantly blurred. People see a stock or a digital asset soaring in price, jump in with their life savings hoping to catch the wave, and call themselves investors. Graham would vehemently disagree. He gives us a razor-sharp definition to separate the two. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations that do not meet these requirements are speculative. Let's break that down into simple terms. True investing involves three distinct elements. First, deep analysis. You must study a company the way a business owner would study a local bakery before buying it. You look at its earnings, its debts, its management, and its competitive edge. Second, safety of principal. Your primary goal is not to get rich overnight. It is to ensure that you do not lose the seed money you started with. Third, an adequate, not extraordinary, return. You're looking for steady, predictable growth, not a lottery ticket. Speculation, on the other hand, is when you buy an asset purely because you hope someone else will pay a higher price for it tomorrow, regardless of the asset's underlying value. Speculators are essentially gamblers betting on price movements. Intelligent investors are business analysts accumulating productive assets. Why does this distinction matter so much? Because your financial survival depends on it. Speculation is highly seductive because it triggers our hardwired human desires for quick wealth and excitement. But history shows that over the long haul, uncalculated speculation leads straight to financial ruin. Intelligent investing matters because it protects you from your own worst enemy, your emotions. By anchoring your actions to cold, hard data and business fundamentals, you insulate yourself from the destructive cycles of fear and greed that periodically sweep through the markets. As we move into Chapter 1, Graham challenges us to cultivate a radical commitment to long-term thinking. The stock market is an incredibly noisy place. Day in and day out, financial news channels shout about daily price fluctuations, quarterly earnings misses, and macroeconomic forecasts. To the untrained eye, it looks like utter chaos. The intelligent investor learns to tune out this noise entirely. When you buy a share of a stock, you aren't just buying a ticker symbol that flashes green or red on a screen. You are buying a fractional ownership stake in a living, breathing business. Think about it this way. If you owned a successful local grocery store that generated great profits year after year, Would you run out and sell at the moment someone walked through the door and offered you a lowball price? Of course not. You would look at the steady cash flow the store produces and politely tell them no. Yet in the stock market, people do this constantly. They see a great company's stock price drop by 10% over a weekend, panic, and sell their shares at a loss. Long-term thinking means looking past the daily price swings and focusing on the underlying engine of the business. If the company is healthy, profitable, and well-managed, its stock price will eventually reflect that reality over time. This brings us directly to risk awareness. Most people measure risk purely by how much a stock's price bounces up and down, a concept Wall Street calls volatility. Graham flips this definition on its head. Real risk isn't a temporary dip in a stock price. Real risk is the permanent loss of your capital. It's when you invest in a flawed business that goes bankrupt, or when you pay such an inflated price for a hot stock that it can never possibly justify its valuation, leaving you holding the bag. To manage this risk, the intelligent investor must adopt an attitude of deep humility. You have to accept that the future is inherently unknowable. No matter how much research you do, companies can face unexpected competition, economies can enter recessions, and unforeseen crises can hit. Therefore, you never put all your eggs in one basket, and you never pay top dollar for an asset, no matter how bright its future seems. Risk management is not about predicting the future perfectly. It is about building a financial fortress that can withstand the unpredictable storms of reality. By shifting your mindset from that of a short-term gambler to a long-term business owner, you immediately gain a massive psychological advantage over the rest of the market. You stop worrying about what a stock will do tomorrow and start focusing on what the underlying business will achieve over the next decade. This is where real wealth is generated, not through frantic trading, but through the patient compounding of a business's intrinsic value. Let's transition into Chapter 2, where Graham confronts one of the most silent yet devastating threats to your long-term financial security: inflation. Inflation is the gradual decline in the purchasing power of your money over time, typically caused by an increase in the money supply and rising prices across the economy. Most beginners think of financial risk in very simple terms. They assume that keeping their money tucked away safely in a traditional bank savings account or a physical vault means their wealth is protected. Graham warns that this is a dangerous illusion. While a stack of cash or a guaranteed bank balance might look completely safe on paper because the nominal number of dollars remains exactly the same, it is actually losing value every single day. If the cost of goods, rent, medical care, and education rises by 3 or 4% a year, and your money is earning next to nothing in a basic savings account, you are experiencing a guaranteed loss in real terms. In 10, 20, or 30 years, that same pile of cash will buy a fraction of what it can buy today. Therefore, protecting wealth requires a strategy that goes beyond mere preservation. It requires a proactive pursuit of real returns. A real return is simply your total investment return minus the rate of inflation. If your portfolio grows by 6% in a year, but inflation runs at 4%, your real return is a modest 2%. That 2% represents the actual increase in your purchasing power. If your return doesn't beat inflation, you are effectively getting poorer, just at a slower pace. Graham explains that to combat this invisible tax on your wealth, you must allocate a portion of your capital to assets that have an inherent ability to expand alongside the cost of living. This is where equities, or common stocks, come into play. Unlike a fixed bond or a cash account that promises to pay you a rigid, predetermined amount of money, a corporation is a dynamic organism. When the costs of raw materials and labor rise throughout an economy, a well-run business with a strong competitive position can raise the prices of its products or services to compensate. As its revenue and earnings grow with inflation, the intrinsic value of the business expands, and its stock price and dividend payouts tend to follow suit over the long haul. However, Graham explicitly cautions against viewing stocks as a perfect or flawless hedge against short-term inflation. History shows that during periods of extreme, sudden inflation, the stock market can actually suffer due to rising interest rates and corporate margin pressures. The protection stocks offer is not a neat month-by-month guarantee. It is a long-term tendency. Understanding this nuance keeps you from panicking when macroeconomics get messy. To ground these concepts in reality, Graham takes us on a journey through Chapter 3, a deep look at a century of stock market history. He forces us to look backward so we can accurately look forward. One of the greatest mistakes an uneducated investor can make is to assume that whatever the market is doing right now is what it will do forever. If the market has been on a massive bull run, meaning prices have been climbing steadily for several years, people become overwhelmingly optimistic. They start believing that the good times will never end, taking on massive amounts of debt to buy stocks at peak prices. Conversely, during a bear market, when prices are crashing and the media is filled with doom and gloom, people assume the financial system is collapsing and vow never to touch a stock again. By studying market cycles across decades, Graham demonstrates a fundamental truth. The stock market is inherently cyclical. It moves through alternating periods of unjustified euphoria and exaggerated despair. These cycles are not driven by cold mathematical logic. They're driven entirely by human psychology. The underlying businesses in an economy do not become 50% more valuable in a single year, nor do they lose half their worth over a single weekend. What changes is the collective mood of the investing public. When you understand this history, your entire relationship with investor psychology flips. You begin to see that the market's wild mood swings are not a threat to your survival, but rather the single greatest source of opportunity you have. When the crowd is greedy and driving prices to absurd heights, history tells you to become cautious, tighten your risk controls, and hold back your capital. When the crowd is terrified and dumping high-quality assets at fire sale prices, history tells you to be courageous and buy. A historical perspective immunizes you against the infectious diseases of FOMO, the fear of missing out, and panic selling. It transforms you from a helpless victim of the market cycles into a detached observer who profits from them. Now, knowing that inflation requires us to own stocks, but market history warns us that stocks can be wildly volatile, how do we actually structure our money? This brings us to Chapter 4 in General Portfolio Policy. Graham introduces a simple, elegant framework for asset allocation that remains the bedrock of modern financial planning, balancing your wealth between stocks and bonds. High-grade bonds represent loans to stable governments or massive corporations. They provide highly predictable, fixed income and excellent capital stability, but lower long-term growth. Stocks offer high growth potential, but come with significant price fluctuations. Instead of trying to perfectly time the market or predict which asset class will outperform next year, Graham suggests a brilliant baseline rule for the average person: the 50-50 split. Put half of your investment capital into a diversified portfolio of high-quality stocks, and the other half into secure, income-generating bonds. This balanced approach acts as an automatic shock absorber for both your portfolio and your emotions. To make this strategy truly powerful, Graham introduces the concept of rebalancing. Let's look at how this works in practice. Imagine you start with $10,000, split evenly, $5,000 in stocks and $5,000 in bonds. Now imagine a massive bull market occurs. Your stocks perform incredibly well and double in value to $10,000, while your bonds remain steady at $5,000. Your total portfolio is now worth $15,000, but your asset allocation has drifted. Stocks now make up roughly 67% of your wealth, exposing you to much greater risk just as the market is reaching expensive peaks. An intelligent investor applying Graham's policy will rebalance back to the 50-50 target. You would sell $2,500 worth of your appreciated stocks and use that cash to buy $2,500 more bonds. This brings your portfolio back to $7,500 in stocks and $7,500 in bonds. Think about the profound beauty of what you just did completely automatically, without needing an expert forecast. You forced yourself to sell stocks when they were high and expensive and lock in those profits into safe bonds. If the opposite happens, The stock market crashes by 50%. Your stock value drops to $2,500 while your bonds sit at $5,000. Rebalancing forces you to sell $1,250 of your safe bonds to buy cheap, discounted stocks. You are systematically buying low and selling high, driven entirely by simple arithmetic and disciplined asset allocation. Graham notes that depending on market conditions, an investor can adjust this ratio up to 75% stocks or down to 25% stocks. But going beyond those boundaries crosses the line into dangerous speculation. Moving forward into Chapter 5, Graham introduces us to a specific persona, the defensive investor. This is the profile that fits the vast majority of people listening today. A defensive investor, often referred to as a conservative investor, is someone whose primary goals are safety of principal, freedom from constant worry, and an investment process that requires a minimal amount of daily attention and effort. If you are a busy salaried professional, a student balancing a heavy workload, an entrepreneur pouring your energy into your company, or someone managing retirement planning, you are a defensive investor. You want your money to work hard for you, but you do not want to spend your nights and weekends analyzing corporate balance sheets or tracking stock tickers. Graham lays out a highly structured, conservative investing strategy designed explicitly to achieve excellent long-term results with minimal friction. The bedrock of this approach rests on 4 pillars. First, adequate diversification. As a defensive investor, you should never pick just 2 or 3 individual stocks. Instead, you aim to own a broad basket of companies across many different industries, typically between 10 and 30 individual positions if you are building the portfolio yourself, or via a single comprehensive vehicle. This ensures that a sudden catastrophe at any single company cannot derail your overall wealth-building journey. Second, focus exclusively on large, prominent, and financially conservative companies. These are market leaders with a long history of weathering economic downturns, carrying low amounts of debt relative to their size, and possessing ample cash reserves to navigate tough times. Third, a consistent record of uninterrupted dividend payments. A company that has continuously paid cash dividends to its shareholders through wars, recessions, and technological shifts has proven that its profits are real, not just a result of clever accounting tricks on a spreadsheet. Fourth, a strict limit on price. No matter how great a corporation is, you should never buy its stock if the price is exceptionally high relative to its average earnings over the past several years. By sticking to these conservative boundaries, you insulate your capital from major structural risks. In our modern ecosystem, the definitive application of Graham's defensive strategy is automated indexing via index funds and ETFs, exchange-traded funds. While index funds did not exist in their current form when Graham penned the first edition of this book, he explicitly predicted and advocated for their core philosophy in his later writings. An index fund allows you to purchase a tiny slice of hundreds of the top companies in an economy through a single, low-cost transaction. Instead of trying to find the needle in the haystack, you simply buy the whole haystack. When combined with dollar-cost averaging, the practice of investing a fixed amount of money at regular intervals, such as every single payday, regardless of whether the market is up or down, the defensive strategy becomes an unstoppable wealth-building machine. It systematically guarantees that you buy fewer shares when prices are high and expensive, and more shares when prices are cheap and on sale. Now, let's look at the opposite side of the coin in Chapter 6, the enterprising investor. This section is for those who are willing to approach the financial markets as an active investing strategy. The enterprising investor is someone who has the time, the deep analytical training, the emotional temperament, and the genuine interest required to actively select individual, undervalued securities with the goal of beating the market average. Graham's warning here is stern and immediate. The pursuit of superior investment results requires a massive amount of intelligent effort. It is not a game for hobbyists or part-timers looking to make a quick buck. If you merely put a moderate amount of extra effort into the market, you are highly likely to achieve inferior results compared to the passive defensive investor. To outperform the market, You must follow a path that is both intellectually sound and fundamentally unpopular with the rest of the crowd. The enterprising strategy is entirely built around the concept of contrarian value investing. To find true bargains, you cannot look where everyone else is looking. You must deliberately seek out situations that the rest of Wall Street has temporarily abandoned or misjudged. Graham highlights a few specific areas where an enterprising investor might find these opportunities. One classic area is out-of-favor large companies. When a major, well-established corporation encounters a temporary setback, such as a public relations mishap, a single disappointing earnings report, or a transient supply chain issue, the market frequently overreacts. Terrified investors dump their shares in a panic, driving the stock price far below what the company's long-term business assets are actually worth. The enterprising investor steps into this chaos, carefully verifies that the company's core economic engine is fundamentally undamaged, and buys the heavily discounted shares. Another sophisticated enterprising strategy Graham introduces is seeking out net current asset operations, often called net-net investing. This is the ultimate form of bargain hunting. It involves finding companies that are selling in a market for less than the value of their current liquid assets, like cash and inventory, minus all of their total liabilities. In essence, you're buying a business for less than the cash value it would generate if you completely shut it down and liquidated it tomorrow, getting its factories, land, and future earnings entirely for free. While net-net opportunities are exceedingly rare in modern, highly efficient markets, the underlying principle remains the golden rule for active investing. You must focus entirely on the relationship between price and intrinsic value. The enterprising investor completely avoids chasing hot stocks, investing based on unverified tips, trying to time short-term market movements, or buying in a hyped-up initial public offerings, IPOs. They understand that the moment they buy an asset based on momentum rather than deep, verifiable calculation, they have crossed the line from enterprising investor to dangerous speculator. Active investing is a demanding profession that requires checking your ego at the door, tuning out popular opinion, and executing cold, calculated math with unwavering discipline. Let's dive into Chapter 7, where Graham pulls back the curtain on advanced portfolio selection. This is where we bridge the gap between abstract philosophy and the concrete construction of a resilient wealth-building engine. The heart of portfolio selection is understanding how to achieve maximum risk reduction without sacrificing your long-term returns. Many people mistakenly believe that diversification simply means owning a bunch of different things. They might buy 10 different technology stocks or invest in 5 different crypto assets and feel secure because they have spread their money across multiple entities. Graham clarifies that true, intelligent diversification requires buying assets that are fundamentally different from one another. If all your investments belong to the same sector, they are bound by the exact same economic gravity. When a regulatory change or an industry-wide slowdown hits the technology sector, all 10 of your tech stocks will plunge simultaneously, regardless of how great individual management might be. To achieve genuine risk reduction, your portfolio must feature a structural mosaic of uncorrelated assets. This means combining large-cap stable companies with high-dividend utilities, consumer staples that people must buy even in a deep recession, industrial firms, and a robust allocation of top-tier bonds. When one part of your portfolio is experiencing a cyclical downturn, another sector should be thriving or holding the line. Diversification is your ultimate insurance policy against your own inability to see around corners. It is the acknowledgement that no matter how brilliant your research is, you can never know which specific company or industry will face an existential crisis tomorrow. This structural protection sets the stage for one of the absolute masterpieces of the entire book, Chapter 8, The Investor and Market Fluctuations. If you only remember one concept from this summary for the rest of your investing life, make it this one. Graham addresses the inescapable reality of market volatility. The stock market fluctuates wildly, often for no logical reason. These rapid up and down price movements cause immense emotional distress for the average person. When the market falls, people feel a visceral sense of financial pain, leading them to sell their positions to stop the bleeding. When a market surges, a frantic wave of greed takes over, causing people to buy when prices are at their most expensive. Graham argues that your ultimate success in building wealth will not be determined by your intellectual capacity, but by your emotional control. He redefines volatility not as a terrifying hazard, but as your absolute best friend. He explains that market fluctuations should only ever mean two things to an intelligent investor: an opportunity to buy wisely when prices fall sharply, and an opportunity to sell wisely when prices rise sharply. At all other times, you should completely ignore the market and focus on the dividends and operational health of your businesses. Think about how this applies to a salaried professional or a beginner investor making regular contributions. If you're a long-term accumulator of stocks, a falling market is a marvelous gift. It means that the fixed amount of money you invest from your paycheck every month is suddenly buying far more shares of great companies than it did a month ago. You are buying assets on clearance. Yet, because of poor emotional control, most people treat a market crash as a tragedy rather than a massive clearance sale. Graham notes that the investor who permits himself to be worried or distressed by unjustified market declines is perversely transforming his basic advantage into a basic disadvantage. Your goal is to remain entirely detached, maintaining a calm, analytical posture that allows you to act rationally while the crowd is losing its collective mind. To make this abstract psychological lesson unforgettable, Graham introduces one of the most famous allegories in all of economic literature in Chapter 9, the brilliant concept of Mr. Market. Imagine that you own a small, private stake in a business alongside a partner named Mr. Market. Every single day, without fail, Mr. Market appears at your doorstep and names a specific price at which he is willing to either buy out your share of the business or sell you a share. Now, Mr. Market has a severe psychological condition. He suffers from wild, uncontrollable emotional mood swings. Some days, he wakes up feeling overwhelmingly euphoric. He can see nothing but a glorious, golden future for the business. On these days, he is terrified that you will buy him out and take all the future gains. So he shouts an absurdly high, inflated price for a share of the company. On other days, Mr. Market wakes up in a state of deep, dark depression. He can see nothing but impending disaster, bankruptcy, and failure. On these miserable days, he is terrified of being left holding a worthless asset. So he names an incredibly low, dirt cheap price, practically begging you to take a share off his hands. Graham asks you a fundamental question. Are you going to let this unstable, emotionally volatile individual dictate your view of what the business is actually worth? Would you let his erratic daily shouts determine your emotional well-being or drive you to make a frantic, panicked decision? Of course not. You would look at his price with complete detachment. When he is absurdly euphoric, you will politely decline his offer to buy, or perhaps gladly sell him your shares at his inflated price. When he is deeply depressed, you will happily exploit his despair and buy his shares for a fraction of their true value. At all other times, you will ignore him completely and focus on the actual profits, cash flows, and operations of the underlying company. The beauty of Mr. Market is that he doesn't care if you ignore him. He will show up again tomorrow morning with a brand new price. He is there strictly to serve you, not to guide you. The speculative investor lets Mr. Market's mood dictate their own emotions. The intelligent investor uses Mr. Market's emotions to their own ultimate financial advantage. This simple shift in perspective completely immunizes you against market hysteria. You stop looking at the fluctuating ticker symbol as a reflection of truth and start looking at it as an expression of a crowd's temporary emotional state. We now arrive at Chapter 10, where Graham unveils the crown jewel of value investing, the concept of the margin of safety. If you were to distill this entire masterpiece into a single, three-word phrase, this is it. Graham explicitly calls the margin of safety the central secret of intelligent investing. It is the golden thread that weaves together everything we have discussed, serving as your ultimate shield for protecting capital and maximizing long-term gains. To understand how it works in practice, let's step away from Wall Street for a moment and look at a simple engineering analogy. Imagine you are a structural engineer designing a bridge. You calculate that the maximum weight the bridge will ever need to carry at any given time is 10,000 pounds. Do you build the bridge to hold exactly 10,000 pounds? Absolutely not. If a single unexpected 12,000-pound truck drives across, the entire structure collapses into the river. Instead, you design the bridge to withstand 30,000 pounds. That extra 20,000 pounds of structural capacity is your margin of safety. It accounts for things you cannot control or predict: human error, severe weather, flawed building materials, or an unprecedented traffic jam. The intelligent investor approaches the financial markets with the exact same engineering mindset. When you analyze a business and determine that its true, calculated intrinsic value is $100 per share based on its earnings and assets, you do not run out and buy it for $100. If your calculations are slightly off, or if the company encounters an unexpected recession, you will instantly lose money. Instead, you wait patiently until Mr. Market gets depressed and offers to sell you the stock for $70 per share. That $30 discount is your margin of safety. This simple principle accomplishes two extraordinary things simultaneously. First, it radically reduces your downside risk. If it turns out that the company's future earnings are slightly lower than you projected, or if management makes a minor misstep, the stock is still worth around $85 or $90. Because you bought it for $70, your capital remains completely safe. You have built a massive cushion that absorbs the impact of human error and bad luck. Second, the margin of safety dramatically supercharges your upside potential. When the temporary dark clouds clear and the market finally realizes the true worth of the business, the stock price will naturally climb from $70 back up to its true value of $100, handing you a magnificent 42% return on your money. The core concepts of value investing, patience, diversification, and emotional discipline all converge right here. A margin of safety is completely useless if you don't have the patience to sit on your hands and wait months, or even years, for an asset to become cheap enough to buy. It is useless if you don't have the diversification to spread that safety across multiple companies, because an unseen fraud or disaster can destroy even a seemingly safe business. And it is completely useless without the emotional discipline to tune out the roaring crowd when they tell you that waiting for a margin of safety is an outdated, old-fashioned strategy. By refusing to compromise on this principle, you ensure that you are always operating with the odds stacked heavily in your favor. You stop trying to predict the future perfectly and instead focus on protecting yourself against the future's inevitable surprises. Let's connect all of this to the legendary Warren Buffett. Buffett didn't just read about the margin of safety. He built the world's most successful conglomerate, Berkshire Hathaway, entirely upon it. His entire value investing philosophy is a direct, unfiltered translation of Graham's core teachings. Buffett famously has two rules for investing. Rule number 1, never lose money. Rule number 2, never forget rule number 1. He doesn't mean that he never experiences a temporary drop in his portfolio's value. He means that he systematically avoids taking risks that could lead to a permanent destruction of his capital. Buffett applies this by seeking out what he calls economic moats, companies with an incredibly powerful competitive advantage that protects them from rivals, much like a wide, water-filled moat protects a medieval castle. Think of companies with irreplaceable brand power, massive cost advantages, or deeply entrenched networks. When these moated businesses experience a temporary, short-term crisis that scares the general public, Buffett uses his massive cash reserves to buy them up with a huge margin of safety. He then lets the power of long-term compounding do the heavy lifting over decades. Compounding is the process where your investment returns generate their own returns, snowballing exponentially over time. Buffett understands that you don't need a massive number of brilliant ideas to build staggering wealth. You just need a few high-quality ideas executed with immense patience and protected by a robust margin of safety. Let's pivot to a critical diagnostic of our own behavior by exploring the most common investing mistakes that Graham warns us about. It is an undeniable historical reality that the single greatest threat to your financial future isn't a bad economy, a political shift, or a sudden market downturn. It is the person staring back at you in the mirror. Human beings are hardwired with powerful psychological biases that make us naturally terrible at investing unless we actively train ourselves to resist them. The first classic blunder is chasing hot stocks. We see this play out in every generation. A new sector, a cutting-edge technology, or a viral asset class starts surging in price. The media covers it relentlessly, and stories emerge of ordinary people getting rich overnight. This triggers an intense cocktail of greed and FOMO, the fear of missing out. Unable to watch from the sidelines any longer, investors abandon all logic and buy in at the absolute peak of the bubble, paying prices that have no connection to underlying financial reality. When the bubble inevitably bursts, latecomers lose everything. This is the definition of emotional investing, a trap completely driven by fear and greed. Greed blinds us to risk when the market is climbing, and fear paralyzes us from taking action when the market is crashing. These dual emotions lead directly to market timing, the futile attempt to predict exactly when a market will hit its bottom or reach its peak. Graham proves mathematically that trying to time the market is a fool's errand. No one, not even the most sophisticated computers on Wall Street, can consistently predict short-term price movements. When you attempt to time the market, you are no longer an investor. You are engaging in pure speculation, gambling your hard-earned savings on the unpredictable whims of crowd psychology. Now, how do we take this masterful framework and apply it immediately to our daily lives? The beauty of Graham's philosophy is that it scales perfectly across all stages of life and professional backgrounds. Let's look at how it applies directly to students and beginners. If you're young or just starting out, your greatest asset isn't a massive pile of capital, it is time. By establishing a defensive investing strategy early, you give the magic of compounding decades to multiply your wealth. You don't need to stress about having thousands of dollars to start. By setting up an automated index fund contribution, even if it's just $50 a month, you are systematically accumulating productive assets. You are training your emotional muscles to view market downturns as a spectacular clearance sale rather than a terrifying crisis, setting yourself up for a lifetime of financial security. For salaried professionals, Graham's defensive model is the ultimate stress-free blueprint. As a busy professional, your primary focus should be maximizing your career earnings and expanding your personal savings rate. You don't have the time to spend 40 hours a week tracking stock charts. By applying automated dollar cost averaging into broad market ETFs and high-quality bonds, you create a self-correcting financial engine. Every single payday, a portion of your income goes straight to work for you. When the market goes up, your portfolio value increases. When the market goes down, your automated contribution buys more shares at a deep discount. It requires zero daily effort, eliminates all decision fatigue, and guarantees that you outperform the vast majority of active traders over the long haul. Entrepreneurs can look at Graham's principles through a unique lens. If you run your own business, you are already taking on a massive amount of concentrated operational risk. Your income, capital, and daily energy are locked inside a single enterprise. Therefore, your personal investment portfolio should serve as a financial counterweight. An entrepreneur should act as an exceptionally conservative defensive investor with their outside wealth. Do not take your business profits and gamble them on speculative, high-risk stocks. Instead, channel those profits into a highly diversified portfolio of large, stable companies and secure, liquid bonds. This creates a bulletproof secondary fortress that ensures your family's financial independence remains completely safe, even if your primary business encounters a severe industry disruption. Finally, for those focused on retirement planning and long-term wealth building, the primary objective is the preservation of purchasing power through the intelligent generation of real returns. As you approach retirement, your asset allocation policy becomes your most critical shield. By using Graham's rebalancing framework, shifting a higher percentage of your wealth into secure, income-generating bonds while maintaining a meaningful anchor in high-quality, dividend-paying stocks, you protect your nest egg from catastrophic market crashes while simultaneously ensuring that inflation doesn't slowly erode your wealth over a multi-decade retirement. You stop seeking exciting, volatile returns and start focusing entirely on predictable cash flows and a robust margin of safety. To wrap up our journey through this financial masterpiece, let's step back and look at the modern landscape of building wealth. Today, we have instant access to incredible, low-cost tools like index funds and ETFs that make executing Benjamin Graham's defensive strategy easier than at any other point in human history. True financial independence isn't about hitting a jackpot or outsmarting everyone else on Wall Street. It is about having the emotional discipline to let your wealth compound quietly over time, far away from the chaotic noise of the daily news cycle. If you found value in today's breakdown, please take a quick second to like this audio, subscribe to our channel, and leave a comment below sharing your biggest takeaway. Welcome to the Growth Room, your ultimate sanctuary for personal and financial transformation. On this channel, we are completely dedicated to pulling back the curtain on the world's most powerful books. We deep dive into investing, wealth creation, peak productivity, success mindsets, and lifelong personal growth. Our goal is to give you the practical frameworks and mental models you need to level up your life, take complete control of your financial destiny, and design a life of true freedom. As you step away from this summary, remember the core blueprint of the intelligent investor. Always separate investing from speculation. Treat a stock as a fractional share of a real business. Use Mr. Market's wild mood swings to your absolute advantage, and never, ever compromise on your margin of safety. Do not chase the crowd, and do not let fear or greed dictate your future. You have the tools, you have the knowledge, and you have the time. Now, it is time to execute. Stay disciplined, stay patient, and keep building. Thank you for listening to The Growth Room, and we will see you in the next episode.